Hello and welcome to the second part of the video lectures for Chapter 4 on the income statement and related information. Uh, last, uh, the last video we covered the first three parts of this income statement chapter, the income statement, the format of the income statement, and some irregular reporting items. In this video, we'll talk about other reporting issues right here, accounting changes and errors, earnings per share, and statement of retained earnings and comprehensive income. So let's get going on that. The three main things we'll talk about with other reporting issues are earnings per share, accounting changes and errors, and then comprehensive income. So the first one here is earnings per share. You guys may have seen this before. All companies report earnings per share. Earnings per share is a common target for compensation contracts. So employees are, so CEOs, executives are interested in earnings per share. It's also the number that analysts usually forecast when they are forecasting a company's future earnings. So, the calculation of earnings per share is net income minus preferred dividends over the weighted average shares of common shares outstanding. So I just want to highlight it's common shares. We're measuring the dollars earned by each share of common stock during the accounting period. So it's net income per share of common stock. So we want net income minus any dividends that would have gone to preferred shareholders. So these are a different group of stockholders who would get paid dividends before a common shareholder would get them. They're preferred shareholders who get preferred dividends. So it's what's left over in net income that would be available to common shareholders. So per share. So that's earnings per share as we calculate it. It's a significant business indicator, like we said. Analysts are forecasting it. It's used in compensation contracts, and it has to be disclosed on the income statement. So GAAP requires this. So here's an example. Lancer Incorporated reports net income of $350,000. It declares and pays preferred dividends of $50,000 for the year. The weighted average number of common shares outstanding were 100,000 shares. So how do we calculate earnings per share? Well, net income minus preferred dividends over weighted average number of shares outstanding, common shares outstanding. So we have all the numbers. We just plug them in, and we get to $3 per share. So that's kind of the extent of what we're going to do with earnings per share. We get later on in this chapter, in this class. Actually, I believe it's in Intermediate 2. You'll talk about this in a lot of detail. Earnings per share is not always this easy. Sometimes you have stock options and things like that that can affect the denominator here, the weighted average shares outstanding, common shares outstanding. You can also have lots of other claims to net income that come before common shareholders that might have to be subtracted off in the numerator here. Earnings per share isn't always this simple, but for this class, we're just doing an introductory kind of measure of this. And it's a common measure of performance for a company, and represents the performance of the company per share of stock. And if you're interested in buying a share of stock, you'd be interested in the earnings, the performance per share of stock. So here's John Deere again. You can see one thing to keep in mind: they calculate earnings per share. It's required under GAAP to calculate earnings per share for all three of these summary measures here: income from continuing operation, income from discontinued operations, and net income. So you see at the bottom of their income statement, they have all three of these calculated: continuing operations here, discontinued operations here, and net income down here. Okay, so I guess that's the basic calculation, knowing that it's presented for, if you have discontinued operations, it's presented for continuing operations, discontinued operations, and overall net income. If you don't have any discontinued operations, you just would have one line for earnings per share just for net income. So make sure you know how to calculate a basic earnings per share number. So that's what this is here. It's these values divided by the weighted average number of shares outstanding. All right. The next part of this video lecture is the accounting changes and errors section. And lastly, we'll finish off with other comprehensive income and comprehensive income. So there could be three different types of things that might happen that would result in a change or error to your reporting. The categories that GAP talks about: changes in accounting principle, changes in estimates, and corrections of errors. So the definition of these we'll talk about in more detail here. If we have a change in accounting principle, we would recast prior year's income statements in the same basis as the newly adopted principle. So let's say there's a new, we're going to change the way that we're going to account for leases. But we have to go back, and for comparability to prior years, we have to recast prior year's income statements using that change in the way we're accounting for leases. So we have to recast prior income statements if we change accounting principle. If we have a change in estimate, however, so we have an estimate of depreciation, the useful life of our building. We changed that estimate of the useful life of the building from 30 years to 50 years. We don't make retrospective adjustments to prior depreciation that we took. We're only going to change the effect, show the change in future depreciation expense that we take. So with change in estimates, there's no retrospective adjustment. If we have a change in accounting principle, we have to make a retrospective adjustment, and we have to recast prior year's income statements under the same basis as the newly adopted principle. If we have a big error, this is a big deal, right? You have a restatement. So you have to go and tell everybody that your accounting was screwed up in prior years. We had a mistake. If it's material, we have to have this restatement where we tell everybody we did a bad job. And we have to restate prior year's income to correct for the error. And then we have to make a retrospective adjustment to beginning retained earnings. So that's a big deal. That's when people start getting fired if you have a restatement. So you don't want that to happen. So the biggest thing to think about here is change in estimate is there's no retrospective adjustment. With a change in accounting principle and a change in a correction of error, a restatement, we do have a retrospective adjustment, and that's going to affect beginning retained earnings, and it's going to result in you putting together prior year's financial statements again, just to come up with what the effect of these two, change in accounting principle or correction of error, was on the prior years. Okay, again, change in accounting principle, there's a retrospective adjustment, and the cumulative effect of the adjustment is going to affect your beginning retained earnings. This is to allow us to have comparable financial statements, so we can look at last year and compare it to this year. So again, I kind of talked about that. Here's some examples. If you changed from FIFO to average cost in the way that you deal with your inventory, we'll talk about inventory in chapters to come. If we do that, we have to, if we change the way that we account for our inventory, then we have to go back and change the way we account for inventory in prior years and show how that would have been reported last year. So you can compare this year to last year. If you had changed from the percentage of completion method to the completed contract method, so if you have a long-term contract, so if you're a construction company and you're building a skyscraper and it takes you 5 years to build that skyscraper, hypothetically, you should recognize the revenue associated with that skyscraper when the project's complete. That would be the completed contract method. But the FASB allows you to use percentage of completion sometimes when you have these long-term contracts, which means as you complete a percentage of that skyscraper, you're allowed to recognize that percentage of revenue. So we'll talk about percentage of completion and completed contract. There's another thing where companies might switch from one accounting principle, one accounting choice to another. And if you change that method of accounting, you're going to go back and you're going to make a retrospective adjustment where the cumulative effect is an adjustment to beginning retained earnings. So that's a change in accounting principle. And again, to highlight, change in estimate is totally different. You're going to account for a change in estimate at the period of the change and in future periods. You don't make that retrospective adjustment to beginning retained earnings. It's not considered an error. It's just a change in estimate. New information came to light. you're going to update your estimates. So this is like changing the useful life or salvage value of depreciable assets, like that building estimate that we talked about in the prior example. Or if your allowance for uncollectible receivables changes, you're just going to make a change in the way that you record the allowance in the future. We're not going to go back and recognize expense in prior years or anything like that. We're not making any retrospective adjustment to beginning retained earnings. Last one, inventory obsolescence. Some of your inventory goes obsolete. That's just going to be handled today and in the future. We're not going back and saying that previous year's inventory was misstated or anything like that. Okay, so change in estimate, biggest thing here, not handled retrospectively. No adjustment to beginning retained earnings. Here's an example of a change in estimate. How do we handle changes in estimates today and in the future? Well, Arcadia High School purchased equipment for $510,000, which is estimated to have a useful life of 10 years, with a salvage value of $10,000 at the end of that time. Depreciation is recorded for 7 years on a straight line basis, and in 2015, year 8, it's determined that the total estimated life should actually be 15 rather than 10, right? So we had said it was 10. Now they decide the total estimated life should have been 15, with a salvage value of $5,000 at the end of that time. So if you get a problem like this, make sure that you know what life they're talking about. In this, they're talking about the total estimated life. You could have a change in estimate, and it could be about the remaining estimated life. That's something totally different. If the remaining estimated life was 15 years, there's 15 more years after 7. This is the total estimated life, so there's 8 more years after 7 years. Anyway, that'll come up in a second. So the questions are, what is the journal entry to correct prior year's depreciation? So the journal entry to correct prior year's depreciation, there is no journal entry to correct prior year's depreciation. What we said in the prior slide was that there's no retrospective adjustment if you have a change in estimate. We don't care. We're just changing. We don't care about the prior years. We care about this year and in the future to make sure that our estimates are correct. So no entry required to correct prior year's depreciation. So then the next part is to calculate depreciation expense for 2015, year 8. So this is kind of a two-step thing to update our depreciation, figure out what it should be in 2015. In the prior years, you would have taken this 510, subtracted off the salvage value, and then divided it by 10 years. That's how you would take depreciation up to year 8. We're going to do that, get the net value as of 2015, and then we're going to implement these new estimates. All right. So here's what we do. So first thing we do, we take the equipment cost, subtract the salvage value, get the depreciable base, divide it over the original useful life. The annual depreciation that we had been taking for the first 7 years was $50,000. So we had taken $350,000 of accumulated depreciation before 2015. So the net book value as of December 31st, 2014 was $160,000. Now we're going to take this $160,000 and depreciate it over the remaining useful life under the new estimates of useful life. So the new estimate is that there was a 15-year life. So there's 8 years left. So 15 minus 7 gives you 8 years remaining in this equipment's useful life under the new estimate, right? So under the new estimate, we're going to take estimates. We're going to take the $160,000 net book value, subtract off the salvage value under the new estimates to get the depreciable base, divide it over the remaining useful life. Again, this remaining useful life is 15 minus 7. We took 7 years already. That's how we're getting to 8 remaining years. And so we can take this depreciable base, divide it over the 8 remaining years, and we get our annual depreciation of $375. And our normal journal entry for depreciation for 2015 is just the $19,375. So if we keep taking $19,375 of depreciation each year for the next 8 years, it's going to be totally depreciated, and we'll have achieved our, accomplished our mission of depreciating this thing over 15 years. All right, so that's change in estimate example. Be prepared to do something like that. So the last part here is accounting for changes in errors is a correction of errors. So you might have a big deal, big problem. You have a mathematical mistake, mistake applying the accounting principles, oversight or misuse of facts. You can have these big issues where we have big errors in prior years related to our accounting. I know when I was an auditor, I was an auditor at General Electric, and they had a restatement related to their derivative accounting, which is really complicated. And the guy that did it got fired. It was a big deal. You know, we had to come back as an auditor, audit restated financial statements from prior years. It's just a ton of work, and it's really expensive. So you don't want this to happen. If you have a big restatement, a correction of error, big error, then you have to go back and restate prior years. You have a prior period adjustment to beginning retained earnings. Yeah, so it's something you don't want to deal with. Again, it's handled in the current year, it's handled similar to a change in accounting principle, but it is a bigger deal because it represents a mistake in your accounting system, and it could suggest that you're not very good at financial reporting as a company. So, so investors take notice when you have a restatement. All right, so that's the last type of accounting changes and errors that we talk about, correction of errors. So the last part of this video lecture is going to be comprehensive income. So what is comprehensive income? We all know the income statement, revenues minus expenses equals net income. The income statement is supposed to represent performance, but you're not really sure if it should represent performance or not. Should it be performance, or should it all be the change in financial position? So that's kind of the controversy that comes up and why we have comprehensive income. So certain unusual items have stirred controversy because people aren't sure if they should be part of net income. So there's this all-inclusive concept, which suggests that the income statement should present all changes in financial position, everything that got you from the balance sheet on December 31st, 2019 to the balance sheet on December 31st, 2020. That's the all-inclusive concept. You want to report everything, including unusual items, directly in the income statement. There's a different group of people who think that the income statement should represent operating performance, current operating performance. It should be a measure of performance. So if you believe that the net income should represent performance, then you want to eliminate some of these really unusual items that don't really represent performance. Instead of having them in the income statement, they should be closed directly to retained earnings or somewhere else in equity. So what the FASB did to kind of reconcile these two viewpoints, whether the income statement should have everything and that represents a change in financial position, or whether it should represent performance, they issued APB Opinion 9, which is a modified all-inclusive concept. So we have net income, which represents performance, and some of these items that are really unusual get placed in other comprehensive income. And if you combine net income and other comprehensive income, you get comprehensive income. So, what's included in other comprehensive income? Things that get to other comprehensive income bypasses the income statement and is taken directly to the equity section. And the things that are included in this other comprehensive income, they're bypass the income statement, go straight to equity, are foreign currency translation adjustments, accounting for futures contracts. So this is like derivatives, hedging, accounting for pension, so the pension obligation, and unrealized holding gains and losses on available for sale securities, which is changes in fair value on some investment securities. So the FASB allows some of this stuff to bypass the income statement entirely, so investors don't look at it because their investors are looking at net income as a measure of performance. These things, companies have either lobbied for these to be moved out of the income statement because they don't think they represent the performance of their company, or they just really don't represent the performance of their company. I know these gains and losses on available for sale holding securities, these investments, the financial industry wanted to exclude those from net income because by including changes in fair value of some of these investments, in net income, it makes their net income look really volatile. And if you were going to put your money in a bank, you probably want that bank to be stable. You don't want it to look like the value of that bank is changing all the time. You want them to have your money in there. You don't want them to take big risks. By having fair value in the financial statements, these banks' net income was fluctuating, was very volatile. So they lobbied to have some of these investments be put in OCI, this other category, so that their net income didn't look as volatile. Anyway, so it is a political process what gets put in OCI, but it's also we're trying to move some of the stuff that represents a change in financial position, but doesn't really represent performance. We're trying to move some of that out of the income statement and be reported in this other comprehensive income section. So it's included in comprehensive income, but not included in net income. So just to reiterate, comprehensive income equals net income, everything on the income statement, right, net income, plus other comprehensive income, which is these other weird things, other unrealized gains and losses on available for sale securities, translation gains and losses on foreign currency, plus a few other ones that we talked about above. The only one I'll bring up in this class are unrealized gains and losses on available for sale securities, because we'll talk about those more when we get to the investments chapter at the end of class, and it's the end of this semester. So, yep. So I might bring that up. That's the only example of OCI, other comprehensive income, that you'll need to know that that's just a component of other comprehensive income. So here's a quick question just to make sure you're paying attention. Gains and losses that bypass net income but affect stockholders' equity are referred to as other comprehensive income. So the ones that bypass net income are called other comprehensive income. Net income plus other comprehensive income gives you comprehensive income. Okay? All right. So how do we report comprehensive income? There's 3 disclosure methods that are allowed. This is from FAS 130 in 1987. You can report it as a second separate income statement. So you might have an income statement that goes to net income, and then another income statement that starts at net income and goes to comprehensive income by adding other comprehensive income. You might have a combined income and income statement of comprehensive income. So you might just have one statement that starts with revenue, goes all the way down to net income, and then keeps going all the way to comprehensive income. Or you might have a statement of stockholders' equity. And so I'll show you 1 and 3 here in a couple examples. So here's a separate, here's Verizon. They report their statement of comprehensive income separately from their statement of their net income, their income statement. So here's their income statement, statement of income, net income. That's where we get to the income statement. Again, we have earnings per share here. We have non-controlling interest. We have all these sorts of fun things that we talked about. But we have net income. That's what we have in our income statement. And then as a separate statement, we have a statement of comprehensive income where we start with net income and we have these other items, and we get to total comprehensive, these other comprehensive income items. So that's what OCI, So net income plus other comprehensive income equals total comprehensive income. All right, so that's the way of reporting separately, separate statement of comprehensive income. Here's an example where we're going to do a statement of stockholders' equity, which is another way to present other comprehensive income and comprehensive income. So here's C. Reether Company. They report the following information for 2018. They had revenue of $700,000, cost of goods sold of $500,000, operating expenses of $80,000, an unrealized holding loss on available for sale securities of $60,000. So that is a OCI, right? OCI. I don't know if you can read that. And then they declared and paid a cash dividend of $10,000 in 2018. So they have, as January 1, 2018 balance is in common stock of, so the beginning of the year balance in common stock is $350,000. Accumulated other comprehensive income. So this hasn't come up yet, but when you have these other items, right, other comprehensive income items, these things here, net income, as you know, clears to retained earnings. These things clear to accumulated OCI. So closing entries for net income dumps it into retained earnings. You also have closing entries for accumulated other comprehensive income that dumps it into accumulated OCI. So in this case, accumulated OCI has a balance of $80,000 and retained earnings has a balance of $90,000. It issued no stock in 2018. So prepare the statement of stockholders' equity. Well, what does stockholders' equity consist of? It consists of retained earnings. It's these items. Common stock, accumulated other comprehensive income, and retained earnings. And so we're going to show adjustments to those three accounts. Okay, so what kind of, a couple things, right? What's net income for the year? Net income is the sales revenue minus expenses, cost of goods sold, operating expenses. So those are our income items. That gives us $120,000. And what's the beginning balance of stockholders' equity? Well, it's these pieces, right? $350,000 common stock, accumulated other comprehensive income of $80,000, and retained earnings of $90,000. All right, so let's do the statement of stockholders' equity. Well, we start with our beginning balances, right? Here's our beginning balance. We calculated at $520,000. It's made up of retained earnings, accumulated other comprehensive income, and common stock. The statement of stockholders' equity is going to take these balances and roll them from 1/1/18 to the beginning balance, the 12/31. Balance of all these categories of stockholders' equity. So this sums this way, and then we sum down. And so common stock plus accumulated other comprehensive income plus retained earnings, it gives you $520,000. We know we had net income of $120,000. We calculated that up here, right? $120,000. That's going to clear to retained earnings. That's the change in retained earnings. So retained earnings is going to go up by $120,000. We had an unrealized holding gain or loss. We had unrealized holding loss on available for sale securities of $60,000. So that's going to reduce accumulated other comprehensive income by $60,000, and it's going to reduce our total stockholders' equity by $60,000. And then finally, we had dividends of $10,000. And that's going to reduce retained earnings by $10,000 and dividends and total stockholders' equity by $10,000. So then we get to the ending balances of all these accounts. So common stock stays the same. Accumulated other comprehensive income goes down to $20,000. Retained earnings goes up to $200,000. And then our total stockholders' equity at 12/31/2018 is $570,000, up from $520,000. All right, so in this way, kind of a statement of stockholders' equity gets at both your statement of retained earnings and your comprehensive income, all in kind of one statement. All right, so hopefully that helps. Last thing for this chapter, just kind of some differences between GAAP, U.S. GAAP and IFRS. With discontinued operations, both GAAP and IFRS follow the same presentation guidelines, but IFRS defines a discontinued operation even more narrowly. So if you want to take a look at that, take a look at IFRS definitions for discontinued operations. Comprehensive income. Mostly this is presented in a statement of stockholders' equity under GAAP, U.S. GAAP. IFRS allows a separate statement of comprehensive income or a combined statement. So again, kind of can pick and choose there. This is kind of the biggest one with IFRS. Revaluation of PP&E and intangible assets is permitted and is reported as other comprehensive income. So you can value property, plant, equipment up, right? So if your building increases in value, you can revalue that up under IFRS, and you can't do that under GAAP. You can only reduce the value of PP&E and intangible assets under GAAP. So that's a big difference between the two. We'll talk a little more about that when we get to long-lived assets in the next exam. Exam 2, I think we cover that. So thank you so much. That's the end of our online video lecture for chapter 4. Thanks.